All right, guys, what's happening? This is Dr. Connor, and in today's video, I'm going to explain to you exactly how commercial or multifamily real estate can be combined with short and midterm rentals so that you can get the highest and best use of a property. So the first thing you need to know is that anytime you do real estate investing, obviously there's a tremendous amount of risk. I don't think anyone's going to sit here and tell you that there's not going to be a bunch of risk, but that risk can be easily managed with a couple different things. The very first thing you can do to manage risk is to do real estate with somebody who knows what they're doing, or do real estate at least with somebody else that can de-risk you. There are many transactions that I've been involved with where we have a partner who doesn't really pull their weight on something, and so when there's problems, these problems end up turning into either a pre-foreclosure or foreclosure or some other type of issue because the financeability of it's an issue, or somebody did a bad buy, or somebody didn't manage the property, or the team didn't really help each other out. Very, very common, okay? So you got to pick your partners properly. But if you want to get into commercial real estate, you're going to be able to get into a different kind of real estate. So if you look at the residential sides are based on comps. When you buy a piece of real estate, if you buy it below the value of the real estate, you can fix it up and then you can sell it at the value or maybe even above the value of the real estate. In the commercial real estate space, there's industrial, there's actually true commercial, and there's multifamily. Industrial is like a big building that someone does painting out of. Your normal multifamily is going to be like your long-term rents. And then you also have businesses, right? Just like other businesses that can be in there. The place that a lot of people are hanging out today or trying to is in the long-term debt multifamily space with a conversion. So the problem is that everyone's used to, on the residential side, having a 30-year mortgage, right? You have the same payment for 30 years. Yes, taxes and insurance change, but you have the same payment for 30 years. Super vanilla, okay? The problem with that in the on the commercial side is that doesn't usually happen. A lot of these mortgages are 25-year amortization, but they change every 5 years. So the first thing you have to solve for is long-term debt. You got to figure out how to get a 30-year fixed debt or 25-year fixed debt or something like this with your properties, which is incredibly difficult to do, but it can be done if you know the right people and you can put together the right loan and you have a good property. The second thing to keep in mind is that the ability to finance a residential piece of property you're living in is based on your income. If you're going to buy a residential investment property, that's going to be based on the income of the other individuals, long-term rents, short-term rents, or midterm rents. When you do multifamily or these commercial type deals, it's based on net operating income and cap rates. Basically, the way that this works is net operating income is the amount of cash flow you would get on a property if you bought it in cash. So it's all the income minus all the expenses without any mortgage. So it pays taxes, insurance, utilities, maintenance, capital expense, all these different things, income minus expenses without a mortgage. That's net operating income. So let's say you had a $1 million property and you get $80,000 a year before the mortgage. That is a $80,000 net operating income. If you divide them by each other, the 80,000 divided by the million, you'll have an 8 cap. Okay. Now an 8 cap is reflective of how much income you received based on the value of the property. If that same $1 million property had $100,000 a year before the mortgage, 100,000 NOI, that would be a 10 cap. Just based on basic math, the 10 cap is better than the 8 cap because you got more income based on the same asset, the same purchase price. So here's where it gets really interesting. Higher return or higher NOI is generally considered a better deal, but it also includes more risk. So the property that does $150,000 on $1 million purchase price is a 15 cap. That's a much riskier model, but it has a much higher return. So remember, as return goes up, risk goes up. As return goes down, risk goes down. Now, you have to decide when you're doing these types of deals, what is most important to you. Some people are very, very, very interested in having high risk, high reward, and other people want low risk, low reward. There are certain people who are just 6 cap buyers. 6%, $1 million purchase price, 60K NOI. Now, probably one of the most important things for you to figure out is what is your exit. So forget all the math for just a second and figure out what is your exit. What we're working on right now is we're trying to combine our experience in the short-term rental space, which is like hospitality, combining that with midterm rental and PadSplit, which is like a hybrid hospitality / long-term rental because people are staying there they're on a week-to-week basis, but they stay for anywhere from 6 to 12 months on average. And then we're trying to combine that with converting motels, hotels, and multifamily units. And the question is, why would you do that? Well, it's really, really simple. If I take a property, I have one right now, it's a $1 million property in New Orleans we're working through. It's got 30 units, 28 of them are actually accessible. And if we were to rent that long term, we would get $28,000 a month, max. Okay, that would be all your income, right? That would be $1,000 a unit. That would be your max. If you ran it as a hotel or motel, which is what they're currently doing, they're actually losing money right now, probably losing about $30,000 a year, and they're underinsured. They're underinsured because they own it in cash, which means that they can have a lower insurance because no bank's forcing them to have higher insurance. So if somebody was to come in and buy this property, what they have to do is they have to pay way more insurance, like what we're going to do, about $30,000 more a year in insurance. And they're going to have debt on the property, and they're going to have to fix up the property, and they're going to have to manage the property, and. So what we're going to do is we're going to take the 28 units, we're going to put them on PadSplit between $185 a week and $250 a week, depending on exactly how the finishes come out. And we're going to slowly ratchet that up to a point where it makes sense. At $250 a week, we're $1,000 a month. We have utility expenses coming in, but our rest of our costs are going to be very stable. Now, the other thing that's really cool about PadSplit is if I have a single tenant leave, the tenant can be replaced by somebody else very, very easily. You can't actually get that when you have a long-term rental, because if someone leaves, it might take you 2 or 3 months to replace that home or that apartment with somebody else. The demand's not always there. So you get this diversification of risk because you have a platform like PadSplit that generates demand, puts people into these 28 rooms, and if someone leaves room 26, they will replace it. So we're going to do this on this unit. Then we're going to try to do this on another 68 units as well in New Orleans. And we will refinance them when we're done. Now, here's the cool part. If you buy it for $1 million with $125,000 down, seller finance $875, and then we turn around and we put $125,000 in renovation roughly into the property, what we're going to find is that long term, what's going to happen is we are going to be able to drive the value of the property up. How does that happen? Well, remember NOI. Our income's going to go way up from where it is today. Yes, some of our expenses will go up, like taxes and things like this, or insurances will also go up. But the income will go up more than the expenses will come up, which will generate a higher profit, net operating income. And then we could take that net operating income on an 8 cap and take it to the bank. If we can get, for example, $150,000 in NOI, I'll do the math on a calculator for you right here. So we take $150,000 in the calculator right there, and then we divide that by 0.08, which is our effective cap rate. That puts us at $1.875 million. That would be the value of the asset after it's stabilized if we can get to $150,000 NOI, okay? Now, in this model, typically there's going to be about 40% expense ratio. So what does that mean? That means if we take the $150,000 of NOI, that's only 60% of the total income, right? So we're going to divide that by 0.6 to get a $250,000 in gross income. So we need $250,000 in gross income to get $150,000 in net income, assuming that we have 40% expenses. So the question is, how do you get the $250,000? I take the $250,000, I divide it by the 28 rooms, and that tells me that I need $8,900, call it $9,000 per year. That's the income I need to generate. Now, if I take that $9,000 a year and I divide it by 12, that'll put me into monthly. So I need $744 a month. If I divide that by 4 weeks, I know there's 4.33 weeks, but I divide that by 4 weeks, I get $186 per week, which is the lowest end that it could possibly do on PadSplit adjusted for vacancy. And so at the end of the day, if we take our 186 times 4 times the occupancy, put all these numbers together, we get $250,000 in gross, $150,000 in net. And effectively what we're able to do is we're able to take our $150,000 in NOI, we're able to divide it by our cap rate, which is 0.08, to get a 1.875 value. Now the bank, in this case, is going to loan us 75%, okay? 75% of that number, which is $1.4 million. That $1.4 million is going to pay off the $1 million purchase price, plus the renovation, plus the hold cost, plus everything that was incurred along the way, which is going to be about $1.2 million. So we should, as long as we do it properly, be able to put the money in, renovate the project, stabilize the income, refinance the project, get all of our money back out, and have an asset that cash flows in a really good spot. Now, let's say we don't take all of our money out, because remember, we're only going to be in for like 1.2 and the bank will let us take out 1.4. Let's just figure out roughly $1.2 million, right? Let's just use that number, $1.2 million times 0.06. Let's say we have a 6% interest rate, okay? Per year, we're talking $72,000. So $72,000 divided by 12 tells us we're going to have a payment, principal interest payment. I know I just did interest only, but principal interest payment of $6,000 a month on an asset that is going to generate 185 times 4 weeks, which is $740-ish a month, times 28 units, but it's generating $21,000 a month. This is a good deal. This is how you can buy good real estate. So if you want to get into something, it's a little bit bigger transaction, it's a little bit harder transaction, it's a lot of moving parts, it's hard to get financing, it's hard to negotiate, it's hard to structure. There's a lot of hard parts, but this is a much better structured deal. And again, as always, I'm not giving you financial advice. I'm not telling you what you should do. I'm just explaining to you how you can add value by using midterm rentals, which there's a lot of demand for right now, with multifamily, motel, or hotel properties that are having struggling demand. If you want to learn more about this, I'll put up more videos about this, but I'm hoping that this helps you think through your next kind of strategy on real estate and hopefully gives you some options to be able to grow.